Okay, let's unpack this. The political landscape always shifting, right? And now President Trump's one big beautiful bill is signed into law. There's a lot to consider. It's got a catchy name, sure, but for you, our listener, with that sharp background in econ, finance, crypto, TradFi, what does it really mean, for your money, your portfolio, your future? Today, we're doing a custom tailored deep dive, really cutting through the noise. Our mission to deliver the deepest facts, the most practical insights. We want to show you exactly how this bill impacts your stocks, bonds, crypto, general holdings, even your home value. We'll peel back the layers, the pros, the cons, and give you solid strategies, whether you're looking to leverage this as a crypto investor or, navigate things as a high net worth TradFi investor. Get ready for some genuine aha moments, maybe with just enough perspective to keep things lively. So this big, beautiful bill, it's officially here. From a high-level economic view, what are the big numbers, the immediate takeaways we need to grasp?
Well, what's immediately striking is the projected economic impact. Analysis suggests the major tax parts of this bill could boost long-run GDP by 1.2%. That breaks down into, let's see, 0.7% growth in capital stock and a 0.4% rise in pre-tax wages, potentially adding nearly 1 million full-time equivalent jobs. The number is 938,000, actually.
Wow. Okay. That really does sound like the rocket ship growth the president talked about. But, every rocket needs a launch pad, and sometimes that pad comes with a hefty price tag. What's the fiscal reality? Any big implications for the national debt?
That's a really crucial question, because while it aims for growth, the bill is also estimated to increase federal budget deficits. We're
Okay.
talking $3.0 trillion on a dynamic basis. That's from 2025 through 2034.
$3 trillion.
If you add in the interest costs, it climbs closer to $3.8 trillion.
Okay.
So this means the debt to GDP ratio, it's projected to rise by 9.6 percentage points. It goes from about 117% without the bill to nearly 127% with it by 2034. And long run, could it be an increase of 13.2 percentage points, pushing it up towards 175.5%?
That's quite a trajectory.
It is. And on a broader scale, even though GDP expands, American incomes, GNP, might not quite keep pace. Projections show maybe a 0.9% rise instead of that 1.2% GDP growth,
Why the difference?
largely due to increased foreign claims on future U.S. output. Comes from the higher borrowing, it's
Yeah.
a classic economic trade-off, kind of like funding a party on a credit card.
And then paying the interest to someone else. Got
Yeah,
it.
exactly.
Okay, let's shift gears from the macro headlines to what really matters for your personal investment portfolio. How do these changes ripple through stocks and bonds?
Right. So from a market perspective, the overall Trump economic agenda, it's broadly seen as pretty market-friendly, especially for U.S. stocks.
Okay, why is that?
Well, a lot of this positive outlook comes from proposed deregulation and, importantly, the promise of tax cuts. The bill makes the expiring TCJA corporate tax rate changes permanent. And there's even talk potential for cutting corporate taxes further, from 21% down to 15% for domestic production.
And lower corporate taxes generally mean?
Generally mean increased profitability, which in turn tends to boost stock prices. It's pretty direct.
And what about deregulation? Is that just, a buzzword, or does it really free things up?
Oh, it's definitely more than a buzzword. Deregulation, especially in sectors like energy and financial services, it could genuinely lower compliance costs, free up capital.
Right, for investment.
Exactly, for investment, for innovation. Think about financial services firms. They could see a real uptick in corporate activity, more primary market stuff, more M&A.
Which is good for stocks relative to bonds.
Broadly supportive, yes. And that ties into the America First strategy, too. Driving more production back to the U.S. could boost industries like manufacturing, energy, creating new investment opportunities in U.S. supply chains.
That paints a pretty bullish picture for U.S. stocks. But policies always have winners and losers, right? Any sectors or maybe global markets that might struggle?
Absolutely. European equities, for example, they might face some headwinds. Even if they aren't directly hit by tariffs, the broader trade policies could weigh on the global goods cycle.
Makes sense.
And the auto sector, that could be particularly vulnerable. Specific punitive tariffs are a real risk there.
Okay, so that's equities. What about bonds?
Bonds, well, they generally face a tougher road under this kind of economic agenda. The outlook for growth, plus potential inflation, it suggests steeper yield curves, possibly higher neutral interest rates.
Which isn't usually great for bond prices.
Typically not. However, the impact of tariffs on bonds is a bit more nuanced. While tariffs can add to inflation, they could also slow U.S. growth. So if those growth concerns eventually outweigh the inflation fears, bonds might actually show some resilience. Yields might get capped.
Interesting tension there.
It is. But one thing to probably expect is a strong U.S. dollar remaining a pretty persistent future. And that often means U.S. treasuries might underperform compared to non-U.S. bonds.
Right. Okay, now, for something that's probably been top of mind for a lot of our listeners, especially with your background in digital assets,
Yeah.
how does this big, beautiful bill and the policies around it shake up the crypto world? This is where people are really looking for actionable insights.
Yeah, this is truly fascinating territory for crypto investors. One of the most dramatic moves is President Trump's no tax on crypto vision. There is an executive order aiming to eliminate capital gains taxes on certain long-term crypto holdings.
Certain long-term.
Yeah.
What's the definition there?
Specifically, those held for over 1 year.
1 year, okay.
And this isn't just, a small tax break. It positions the U.S. as potentially the first major economy to embrace such a deeply crypto-friendly tax regime. It's a real statement, like declaring the U.S. a crypto-native economic zone, almost. And the plan is broad. It applies to centralized platforms and peer-to-peer networks across DeFi decentralized finance. It also explicitly tells tax agencies to minimize reporting burdens for individual crypto holders. And it directly nullifies previous efforts by the IRS to expand the definition of a broker to include DeFi exchanges.
That's a huge reversal.
It's significant, yes.
So, okay, that sounds like a potential game changer. But what does it really mean for you, the crypto investor listening right now? How do you actually leverage this? Is there a catch?
Well, for the long-term crypto investor, it's a clear signal.
Yeah.
Hold. It explicitly incentivizes strategies for assets like Bitcoin, Ethereum, altcoins. Strategies that prioritize holding for over a year, rather than, quick speculative trades.
Discouraging flipping, encouraging HO dealing.
Pretty much. It aims to strip away a lot of the tax complexity, the paperwork, stuff that's frankly discouraged many people from even entering the space. Or maybe caused experienced investors to hold back on more active trading. The overarching goal seems to be solidifying American dominance in digital assets and attracting, frankly, massive new inflows of capital.
Okay, sounds great. What's the fine print, the potential downsides? Critics always have something to say.
They do. And the concerns are, well, first, it could significantly reduce federal tax revenue. Second, some worry it might encourage speculative bubbles. And third, arguably, it could primarily favor the wealthy who tend to hold larger crypto portfolios.
Right, the concentration of holdings issue.
Exactly. And critically, remember, this addresses federal taxes. State-level capital gains taxes might still apply.
Good point. Don't fire your state tax advisor just yet.
Definitely not. Also, there's a working group actively focusing on future proposals. Things like clearer frameworks for crypto custody, using blockchain and government-specific incentives for U.S.-based crypto companies.
So more regulation or guidance coming.
Expect efforts to tie stablecoins directly to the U.S. dollar, too, reinforcing America's leadership. For you, the smart investor, this means holding periods become even more critical for that potential tax-free treatment and wealth management strategies. They'll need to increasingly integrate crypto alongside traditional assets. It's not niche anymore.
It's becoming a cornerstone for many portfolios.
Precisely.
Okay, moving from the markets and the wild world of crypto, let's bring it even closer to home. What does this bill mean for your individual finances, your wallet, your home value?
Right. So for individual finances, a big piece is making the expiring TCJA individual tax rates and brackets permanent. This generally benefits anyone in the 12% bracket or higher. Some of the biggest percentage cuts are actually for those in the 24% bracket and above.
Okay.
And crucially, the standard deduction increase, the one that nearly doubled under TCJA.
Yeah.
That also becomes permanent. And it gets enhanced starting in 2025. We're talking $31,500 for joint filers, $23,625 for head of household, $15,750 for others.
That's a big deal for people who don't itemize, most middle-class folks, right?
Exactly. Simplifies things, likely reduces their tax bill. Then there's the child tax credit, also made permanent, increased to a max of $2,200 in 2026.
Good for families.
Significant support, yeah, especially middle class. And for older listeners, a temporary senior deduction. $6,000 for qualifying individuals from 2025 through 2028.
Okay, here's where some of the more granular and frankly kind of interesting individual deductions pop up. The bill includes temporary tax deductions, up to $25,000 for tip income.
That's right, and up to $12,500 for overtime pay or $25,000 for joint filers.
But temporary, expiring in 2028.
Both expire in 2028, yes.
And there's even something about car loans.
A temporary auto loan interest deduction, yeah, limited to $10,000, but only for new cars with final assembly in the United States.
Ah, the America First angle again. It's like they're nudging specific behaviors with these small targeted breaks.
They certainly seem to be, and that's also where some criticism comes in. While these no tax on things sound appealing, many are temporary.
The 2028 expiration date.
Right, so for, say, blue-collar workers, the cap on the overtime, or tip deduction, it means the actual annual tax saving might only be around $3,000. Some argue that's not really significant enough, especially with inflation or compared to, the total tax taken from big paychecks.
Fair point.
Yeah.
What about the broader economic and social picture here?
Well, while middle-income groups might see the largest percentage income increases short-term from these breaks, the bill also involves pretty significant spending reductions. Analysts have pointed to what they call the largest Medicaid and SNP cuts in history.
Oof, that's where the criticism about.
About it potentially making the poor poorer while making the rich richer, yes, that's the critique. Also, the permanent elimination of the personal exemption, even with the higher standard deduction and child tax credit, that could still negatively impact larger families compared to how things were before TCJA.
Something for bigger families to model out carefully.
Definitely. And one more thing for those focused on green initiatives, many Inflation Reduction Act tax credits for individuals.
Like EVs, energy efficiency.
Those are repealed after 2025, so it's a real mixed bag, a complex tapestry of give and take.
Okay. What about for high net worth individuals specifically? Any major changes there?
Yes, a very significant benefit. The bill permanently increases the estate and lifetime gift tax exemption. It goes up to an inflation-indexed $15 million for single filers, $30 million for joint filers, starting in 2026.
15 and 30 million. Index. That's huge.
It allows substantially more wealth to pass to families without hitting the so-called death tax, a major win for wealth planning.
Got it. Now, real estate, housing markets, always a hot topic. How does the bill affect that?
Several parts could have an impact, though likely not uniform across the country. A key provision is the temporary increase in the state and local tax deduction cap, the SALT cap.
Ah, SALT. Always controversial.
Indeed. It goes up to $40,000 for 2025, then increases by 1% per year through 2029, before snapping back to the old $10,000 cap.
40,000. That could mean real savings for homeowners in high-tax states.
Thousands a year, potentially, especially in places like New Jersey, New York, California, Massachusetts, and metros like San Jose or the New York City area.
Okay, but who benefits most from that?
Well, this change disproportionately benefits higher income buyers, people who tend to have larger state and local tax bills. So while it could, as some say, supercharge demand and maybe push prices even higher in already expensive markets, it offers less comparative help for lower income renters or first-time buyers who are really facing affordability crunches.
Right. So for the real estate investors and professionals listening, what's the takeaway for their strategies?
This is, well, unequivocally a big win for the real estate industry itself. The bill introduces a permanent qualified business income deduction, QBI. And crucially, it brings back 100% bonus depreciation.
Bonus depreciation. Explain that quickly.
It allows immediate full deduction of qualifying renovations, property improvements, certain building components, instead of depreciating over many years. You write it off now. That should really stimulate activity, development, upgrades.
Okay, big incentive there.
Huge. And there's also a special depreciation allowance for qualified production property that benefits investors in things like logistics, warehousing, production facilities, ties back into that manufacturing push.
Gotcha. What about the supply side of housing? Anything to help build more homes?
The bill does expand the Low-Income Housing Tax Credit, LIHTC, and it tweaks Opportunity Zone incentives. Both are tools meant to support affordable housing development.
But will it be enough to fix shortages?
Probably not quickly. Large-scale supply impacts take time. It won't relieve pressure in high-cost cities anytime soon. And on a less positive note for supply, terminating some of those energy-efficient home credits that could actually lead to higher prices for new homes, or even cancellations of some projects, further disrupting supply.
So again, a mixed bag. Incentives in some areas, disincentives in others.
It's complex, yeah.
Okay, let's try to draw all this together now. For our high net worth TradFi investors specifically, what are the absolute key takeaways? What should they really keep a close eye on? What are the strategic plays?
Right. The core message for them is still largely an investor-friendly environment. driven primarily by lower capital gains rates, that big change to the estate tax, and broad business tax cuts. These directly boost after-tax returns and make wealth transfer much easier.
Okay, so favorable on taxes and wealth transfer. What else?
Pay exceptionally close attention to interest rates. That's critical. If rates keep rising, borrowing costs go up. That could cool down market competition for deals, especially in real estate.
Which could be an opportunity.
Paradoxically, yes.
Ruh.
For well-capitalized investors, it could create unique, maybe better-priced opportunities. Conversely, if rates stay low, cheaper financing keeps fueling activity. In that case, locking in fixed-rate financing might be a really smart move. Protect against future heights.
Hedge against rate risk. Makes sense.
Tariffs are another huge one, central to the America First strategy. While they're meant to boost domestic industries like manufacturing, they also raise costs for anything sourced overseas. That hits sectors like retail, potentially challenges multinationals with complex supply chains.
So investment strategy needs to consider.
Which U.S. industries might capitalize on demand for local goods, but also be very aware of the global supply chain impacts, potential retaliation. It's a delicate balance.
Got it. Anything else?
Yes, finally, and this is crucial, remember the temporary nature of many of those individual tax provisions. Tips, overtime, the auto loan deduction, they mostly expire between 2028 and 2030.
Creating a kind of political tax cliff down the road.
Exactly. It means smart, long-term financial planning has to factor in a high probability of future legislative battles, potential tax changes, especially for middle-income folks. This isn't just about the bill itself. It's about anticipating that next political dynamic.
Planning for future uncertainty.
And always, always keep an eye on the long-term debt implications. Despite short-term growth, that remains a critical factor, a quiet hum beneath all the headlines.
Okay. So there you have it, our deep dive into President Trump's big, beautiful bill, trying to understand its multifaceted impact on your financial landscape. We went from the macro shifts down to the nitty-gritty of your stocks, bonds, crypto, your home. The aim, as always, is to equip you with knowledge to make informed decisions. Quickly, thoroughly. We really hope this deep dive gave you those aha moments you were looking for.
And maybe this raises an important question for you to think about. Beyond the immediate financial impacts we've discussed,
Right.
what single aspect of this big, beautiful bill do you think will have the most surprising, perhaps unintended ripple effect on the U.S. economy, or maybe even the global economy over the next 5 or 10 years?
Something to chew on. Keep digging, keep learning, and thanks for joining us on this deep dive.